One.
Hi, everyone. This is Live with MainStreet. Jim Ludwig, Anna Sagunina, and Eric Jorgensen.
How are you doing, guys?
Good morning.
Great.
Well, we have an interesting topic today, and actually we've decided that that was going to be a theme of the month for all of our writing, the tweets, and so forth, because we get asked a lot questions about long-term care. How much do people actually need? How do they pay for it? What kind of options are there? How expensive? So all those kinds of questions we get to answer pretty much in every financial plan we do, more for clients who are closer to their retirement or a little bit older rather than younger. So we thought that we get together and kind of discuss all these different questions to cover all these topics with you. What do you think, guys?
Great. We're ready to go.
Okay. So let's start with the most basic question. What is long-term care, and do we think that every client in every financial plan needs to have long-term care? Who wants to take this one?
Well, I'll take the definition of long-term care. Long-term care is either hiring someone or someones to come to your home and do things that you can no longer do, to help you cook, bathe, get dressed, go to the bathroom, all sorts of things that you may not be able to do because of lack of mobility. And sometimes your home just isn't a good location, so you need to go someplace else, and they call that assisted living. It's the same kind of issues. And then, unfortunately, if people are really immobilized and not able to do almost everything for themselves, then we call that skilled nursing. Sometimes that's rehabilitation, and sometimes that's just custodial care. So those are the three platforms where long-term care services are rendered.
Right. So when people think about long-term care, and a lot of times they come to us and say, okay, I've been told that I need to buy long-term care insurance, right? They don't necessarily yet establish whether they have a need. They first say, well, I need to buy long-term care insurance because they understand that these things are going to come and someone will have to pay for it. So the first thought comes to mind is, oh, we need to get insurance, but then they get the quotes and they realize, oh my gosh, it is quite expensive. So let's talk about for a minute about the actual needs and how we as planners look at everything that they've got, all of their resources, all the types of income and assets, to determine whether they actually need the insurance itself, rather than maybe self-insuring, which is another option.
So some of the options they have for funding long-term care is if they have enough assets, if they have enough investments to use to pay for without affecting their retirement or their spouse's retirement. Perhaps they have a life insurance policy that has a long-term care rider on it that allows them to use a portion of their cash value or death benefit to pay for the long-term care expenses. Those are a couple of the different options that they may be able to use without necessarily taking out a long-term care insurance policy. Jim, do you have a couple other you'd want to add?
Well, home equity is always something that people who live on either coast of the United States have an opportunity to maybe tap into. If you live in the Midland of America, people haven't seen the rise in home prices sufficient to raise equity where they might be able to tap into it, and usually people tap into it by either selling their house and downsizing, or in renting, or a reverse mortgage where they can tap into the majority of their equity to pay for things like long-term care services. So that's another option besides their income streams and their savings.
Mm-hmm. Right before our session, I actually found an interesting link, and I'll share it under our video below. It's on Genworth.com website. Genworth is one of the main insurers for long-term care. and they have a calculator that you can actually use to figure out what these kinds of costs you can anticipate, whether you have somebody coming to your home to provide the care, or you starting with that, all the way from going to the nursing home, or maybe even having going to an assisted living facility. So just to give you an idea, for 2016, assisted living facility could cost about $3,600 per month, and that's when you have an independent apartment and you just use some of the services, but you're quite capable of taking care of yourself. And then if you go to a nursing home, that's where you get the full care. That could be up to, or as much as $7,700 a month. So those are just to kind of give you a range how it could start. And a lot of times when we in our plans for clients, when we look at, okay, what kind of need should we plan for? Because if you start out needing care in home, it may be gradual, right? You may need somebody to come over for a few hours a day, and we have plenty of examples for clients right now, all the way when you actually start needing around-the-clock care. And so looking at somebody's resources first and saying, okay, if we're going to need somebody to come over for a few hours a day, how long will that last, right? And then you think, okay, well, at some point I'm going to need more care. How long will that last? Obviously, we aren't exactly sure how, but we can look at statistics and see how long people stay in these types of facilities, or how long the care is needed. And then we sort of work it backwards. We look at the resources that the clients have, right? And if those resources aren't enough, then we may recommend a long-term care policy. And a lot of times it's actually just a supplemental long-term care policy. It's not a full-blown policy that pays for the entire cost, because those tend to be more expensive. And we just this month, in the last, or it's only August 8th, but in the last week we've heard from a lot of our federal employee clients, right, because they all received a letter in the mail saying that they're going to have a rate increase. Those are the clients who have long-term care bought through the federal program, or through their as a benefit of being federal employees. So can we talk for a minute about what is happening in that arena, and what could some people do? They already got the policy in place, and some of them have great policies in place with really nice inflation, but the premiums are going to go up. What can they do?
Well, Anna, first of all, the premium increases are anywhere from double to triple to keep their same benefit. In most cases, it was an unlimited benefit. That means as long as they were in the nursing home, we'll just use that as an example, that they would get reimbursed up to a certain amount. Usually it was $250 to $350 a day, and they had a compound inflation rate of 5%. What happened with the renewal of the contract with John Hancock, which is the current provider and the future provider, they realized that the claims experience was too high and that they were on the hook for too much, and they demonstrated to the Office of Personnel Management that awards the contract that they need increased premiums to maintain the ability to pay these claims. So they offered the recipients of these policies, the owners of these policies, an option to reduce the expected increase once they go on claim. It doesn't mean every year, but once they go on claim, that if they reduced it to a more modest amount, they could reduce the rate of increase or keep the same amount. And so those were the three options that they were offered: double to triple increase, maybe just a double increase and keeping it just the same, but reducing the inflation change on their benefit.
Mm-hmm. Okay, so when somebody is assessing these options, right, and because at some point ago they purchased the policy and they had an idea, right, or some kind of a calculation that, okay, that I need this much per day, this will be my inflation, and I'm comfortable with, because that's going to provide enough resources. So now the premiums are going to be increased, and many of people don't necessarily want to pay that much, or maybe can't even afford. So when they are making a decision at this point what to do, what should they look at? Should they reevaluate how much, what are their assets now? Could they self-insure for some of the cost up front?
Well, Anna, what I did in most of the cases where I answered this questions for some of our clients is I went in and calculated the difference between the current inflation rate increase and the proposed reduced inflation, and then I calculated the future value when they were 85 years old, and in many cases it was $40,000 to $50,000 more of assets they would need because they didn't increase the premium that much. And so it might be setting aside $20,000 in today's dollars, growing to say $45,000 in future dollars. And then I looked at their assets. Did they have enough to do that? In most cases, they had more than enough. And so I recommended they take the reduced inflation rate that kept their premium the same, but to think about setting aside more assets for long-term care expenses that they would have to self-insure for. But since the expected claim is 40%, that meant in 60% of the cases they would still have that extra $45,000 that would go to their heirs because they didn't have a claim. But with a couple and the expected percentage of claim being around 40%, that means that one out of the two has got a high probability of having a claim that goes on beyond 90 days. That's the rule of thumb when they look at the percentage probability of claim. It's got to be something where you have a need for more than 90 days.
Great. So I'm sure we'll be hearing more from our federal employee clients about this question. And like I said, we're going to be writing articles and tweeting throughout this month and answering your questions specifically on long-term care. But I'm currently working with a couple right now who it's actually the children of a couple who hired me to help them figure out how could they pay for the long-term care when they don't have enough resources and they don't have long-term care insurance and they're in their late 70s, which probably means they won't be able to buy or be just priced out. So there's something called Medicare option, and could we discuss how people can utilize that route of paying for care and what should they think about? Eric, you want to chime in?
Sure. So Medicare won't pay for long-term care insurance for the actual long-term care facilities after 90 days. If for somebody that needs longer care, they're going to have to apply for Medicaid. And Medicaid has something called a 5-year look back, where they're going to look at what your assets and your income is for the last 5 years. And they want to make sure that you don't have too much in assets that you would be able to pay for your own long-term care. If you don't, then Medicaid would pay for it, and they would pay for it. There would be no money out of the family's pocket. If there was, let's say the family had $50,000, but they tried to get rid of it so they could qualify for Medicaid. So every year they gave their children $10,000. What the state would do is they would say, well, it costs us, let's say, $5,000 per month to pay for 1 month of long-term care. So you had $50,000 that you gave away over the last 5 years. We're going to divide that by the $5,000 per month it costs us, and that means you would have to wait an additional 10 months to qualify for the Medicaid. So as long as you have less money saved up or invested than what it's going to cost for the state to pay for your long-term care, then you're fine. If you're married, they're only going to look at 50% of your assets because they recognize that the spouse needs to live. So they don't want the spouse to go broke. So they split the assets 50-50.
Mm-hmm. And I also have heard that they allow you to keep your home, right? So
Correct. They will not force you to sell your home.
Yes, in the case of a couple, then the other person can stay, so if for example one of the spouses chose to stay in home, will the care be provided in home?
Yes, it could be. One of the spouses could receive care. But I don't think Medicaid would pay for in-home care. Jim, am I correct there? Medicaid just pays for, you have to be in a facility, correct?
That's right, supervised facility. There's two caveats, Anna and Eric, I want to point out to our viewers. Number one, the states are now routinely leaning the houses to recover the cost of Medicaid once the recipient is no longer alive. So you need to be aware of that. The federal government has got on the states for not going after retrieving of assets that the government has paid for in advance. Because remember, the government, the federal government, is funding Medicaid, but it's administered by the states.
Yes.
So the states have been lax in going after people's assets after they've died to recover that cost. There's another caveat, and that's a Medicaid bed. As you know, that I'm a former hospital administrator, and Medicaid beds in a nursing home situation, usually there's only 2 to 4 in a facility that, say, would have 100 or 150 beds. And for the children of the potential recipients of Medicaid care to go around from facility to facility to find a Medicaid bed is very difficult. However, if you start out as a paying patient in a facility and then you run through your assets and you go on Medicaid, the law says they cannot eject you and turn you out from that nursing home. So you then become a Medicaid recipient without having to find a Medicaid bed. That's really important to understand, because some people's Medicaid strategy, by getting rid of all their assets, then it's very difficult to find a Medicaid bed.
Mm-hmm. As you were talking about the homes starting to be leaned, one of the thoughts, I think you mentioned this earlier, Jim, is reverse mortgage, right? So if you happen to have a house that's paid off, right, and you have a spouse and the care is needed, so what can we take advantage of a reverse mortgage to pay for the care? Because if at the end of the whole process the house is going to be taken back to recover the costs, why not use it in the first place, or at least consider using it?
Those are good points to remember for people, Anna, that a reverse mortgage taps into the equity, and a reverse mortgage line of credit that you might apply for now and you might need 15 or 20 years from now, then it grows 4 or 5% a year, is another option also, besides tapping into the money right away. And that's something that we'll be covering later on this month in a special Swim with Jim interview of a reverse mortgage broker when we talk about that line of credit. So thinking in advance of 15 or 20 years of maybe tapping into the equity rather than waiting till the last minute when you need it, because it does take a few weeks, even maybe a month and a half, to tap into that. In the meantime, the facility is asking for money, and what do? Put it on your credit card? It becomes difficult.
Yeah, I think we're just about out of time for our episode today, but I think we've touched on a lot of different points, and I hope when our clients or prospects are watching this, that this gives you some ideas. Obviously, everyone's situation is very different. That's why we're here, to help you through these decisions. So, but stay tuned for all of our content coming out this month, and we're welcome any questions, and we'll see you next month. Thank you so much, Jim and Eric, for your participation, and everybody have a great day.